Barloworld recorded a 31% rise in interim headline earnings per share to 321 cents. Revenue increased 11% to 31.3 billion rand. Earlier, Samantha Loring spoke with company CEO Clive Thomson to find out more. Here's that conversation.
Yes, there are probably three very important ones. The first of which is with Swakop Uranium in Namibia. This includes some of the sort of Bucyrus equipment from the business we purchased, some big hydraulic and rope shovels. Then there's First Quantum Minerals in Zambia on the Zambian copper belt, also mainly Bucyrus equipment. And then more recently a B2B gold order out of a company operating an open cast gold mine in Namibia. So those three, two of them are in excess of $1 billion and one about $500 million.
But of course, you know, the big story at the moment is the slowdown in the mining sector, the pullback that we've seen announced by major mining companies when it comes to capital expenditure. So how are you seeing that reflected in your operations?
Yes, I think that's true. I mean, there are definitely signs of a global mining capex slowdown as commodity prices have come off their peak levels. We're probably slightly better placed in our operations in Southern Africa and Russia than other parts of the world, simply because of the number of projects that still seem to be continuing. And I guess also the most stress being felt in South Africa at the moment is in the platinum and gold sector, which is mainly underground, and we have relatively low exposures to that. So it's not that we're immune to it, but we're probably less badly affected than could be the case.
The Southern African operating profit margins for the equipment side have fallen back to 7.2%. So why is that? I mean, do you see any pickup anytime soon then on those margins?
There's a combination of three effects. Firstly, some currency impacts of the weakening rand. The second impact is the Bucyrus business, which we purchased, does operate at lower EBIT margins, around 5%, whereas traditionally we operate in the CAT business north of 9%. So that had a dilutionary effect on margins. And then also we continue to build our cost base, some longer term facility expansions and a new component rebuild centre we've put together, which really is building for future capacity.
On the Russian side, I mean, looking at operating profit there, 157 million rand. It was slightly up from the previous period. You've also been spending money on growing your presence that you have now in Russia. Walk us through the outlook and the type of visibility you're getting from Russia, specifically in the mining space.
We've allocated about $80 million of capital to facility expansions in the region. Our historic sort of strength has been in Western Siberia. We're expanding out now into Eastern Siberia and the Russian Far East, where we're seeing some very big gold and other projects that are happening. Our market shares in Russia are also relatively low because we only went there in 1998. So in order to really build capacity for future growth, we've got to make these investments. And over the next sort of 12 or 18 months, we've got some quite good visibility on some big projects with Polish Gold, with Norilsk Nickel, and there's also a large Urukan copper project which is in the horizon.
Do you think that you can build up your market share in this market? How competitive is it?
It is competitive. I mean, all of the so-called Western manufacturers are in Russia, but the mining space has been dominated by a Belarusian manufacturer called Belaz, and the equipment is not of the same quality of ours, but it's also substantially cheaper. So, you know, we've certainly made inroads over time, from 0% share when we started in 1998 to kind of 15% shares now, but we believe we've got significant inroads still to make.
Made significant inroads in terms of improving your earnings from Iberia. I suppose you're still making a slight loss there of 5 million rand, but you're almost breaking even, in fact. So massive restructurings that have gone through in that economy. And interesting that you're sending technicians now on a temporary basis to Africa. So tell us about how you're sustaining operations in Iberia right now in light of the prolonged recession.
Yes, I mean, you're right. We've seen a tough sort of 4 to 5 years in Iberia from the peak in 2007 as the construction industry has fallen off. We have significantly reduced our cost base there, and therefore it was pleasing to me to reach a sort of a break-even position this year, given that the external environment remains difficult in Spain. One of the things we have looked at in order to maintain our technician capacity in Spain for ultimately when the market does turn is in the short term redeploying some of those technicians to mining projects in Africa. And we've got technicians working in Angola, in South Africa, in Mozambique, in Malawi, and it's a win-win because we're short of certain technical skills here in Southern Africa. Many of these Spanish technicians are very experienced, and at the same time it provides that Iberian business with the ability ability to maintain its capacity.
Your order book overall for the equipment side is sitting at 5.2 billion rand, and it's down from 5.3 billion where it was last year, September. So can you break that down for us and give us your view on whether it's going to fall any further from these levels, given the fact that it's very much tied to mining sector spend?
Look, I think the first thing to say is that of that order book of 5.2 billion, about 2 billion rand is the Bucyrus equipment, or what we now call EMPR. So that has certainly bolstered overall revenues and that order book. We also pleasingly have got quite a bit of commodity diversity, so we're exposed to coal, copper, diamonds, uranium, gold, less exposure to platinum, and that also provides us with some resilience. So we could see it come off in the short term to September, but we still believe the long-term commodity outlook and mining capex outlook is solid.
Yeah, on the automotive and logistics side, revenue up there 15%, 16.3 billion rand, and operating profit up 27%. So you said this was, a highlight when it comes to the performance for the Barloworld group. But on the Avis side, you've talked about, rates coming under pressure still. So perhaps you could elaborate on that. I mean, will that have a material impact on earnings? Do you see that having that impact?
Yeah, I think, look, you're right. Overall, I think operating profits being 27% up was very positive for us in the period, because the external environment hasn't exactly been buoyant. On specific to your question on Avis, yes, rates remain under pressure there because it is a very competitive trading environment. But notwithstanding that, our profits were up 13% in Avis Rent-A-Car and 44% in the fleet services business. So notwithstanding some of those competitive dynamics, I think we've produced a credible results in both of those businesses.
So do you think earnings are going to be sustainable for this part of the business, especially in light, I suppose, of motor retail, which has continued to perform really well, and everyone's questioning when the slowdown in vehicle sales is going to come?
Yes. Look, I think new vehicle sales will probably slow somewhat in the back half. In the front half we had about 10% growth in new vehicle sales for our business. That may come off a little bit in the back 6 months as consumers come under pressure and consumer indebtedness remains high. But notwithstanding that, I'm expecting a pretty solid result for our automotive logistics business in the back half.
Mm-hmm. So taking a step back and looking at Barloworld now, where you've disposed of some assets on the handling side in the UK, the US and Belgium, but you've also had this Bucyrus acquisition, which has really been key to Barloworld's earnings this time around. What do you see as, how do you see the business positioned right now in light of the fact that we still got, if you look at it from a global perspective, this kind of sustained slow recovery?
Look, I think we broadly, in terms of the composition of our portfolio of businesses, I think we're broadly comfortable with that now, with a strong presence in the equipment market and a strong presence in the automotive logistics market. So we recognize that we operate in cyclical industries, but we've got good geographic diversity, and we've also got good commodity diversity, and the automotive logistics side run to a different cycle than the equipment side. So I think that builds resilience into our business model. So overall, I'm comfortable with how things are progressing, and as I said, this year we've disposed of the Handling Belgium business, which continues that ability for the group to redeploy capital into areas which are generating higher returns.